Okay folks, we will be talking a lot about profitability metrics in this video here. And I would like to explain you for which purpose do you actually take which profitability metric in your income statement. You know that we have various profitability metrics, and obviously depending on the purpose of your analysis, we will use different ones. So typical things consultants or controllers do, they actually come in and they want to benchmark your business. That's one reason you can look at profitability. One other reason could be you would like to pay a bonus to your manager. And you might use a different metric for this purpose compared to what consultants are using. And then there's the owner. The owner really cares about what is truly left over from the business after all. So why don't we start with a simple income statement and look at the different subtotals which we actually have to cover here in the next minutes. Obviously, the first one is gross profit. We need to discuss who uses gross profit to actually analyze the business. Gross profit doesn't really incorporate an awful lot of costs. Well, depending on the business you're actually dealing with, for example, a retailer, it might actually cover already significant costs, because cost of goods sold, we have to ask ourselves, in a given business model, is this actually an important number, a significant number when it comes to size? Then we come to earnings before interest and taxes, EBIT. That is a very commonly used number for many companies. For example, putting your bonus on this number. Do you get a bonus or don't you get a bonus as line manager? This depends actually on your EBIT oftentimes. We don't see here in this income statement the little sister of EBIT. The little sister of EBIT is EBITDA. What is EBITDA? Earnings before interest, taxes, depreciation, and amortization. That's a number I hadn't heard of 30 years ago when I started my finance career. Those days, it's actually becoming a pretty commonly used number, and we have to talk about the reasons for that. Then we go to earnings before taxes, and finally, there's the net income. And there is a reason why many people actually use net income to actually look at companies. So let's go through those different line items, these different profit figures, line by line, and ask ourselves, why are companies actually using this particular profit figure for these particular purposes we should talk about. So first thing we mentioned already, gross profit, which sometimes is also expressed as a percentage of net sales. And in that case, it's called gross margin. So which industries actually use this number to look into the question, how are we actually doing? And clearly what comes to mind here is retailing. If you talk about a classical retailer, let's talk about a discounter, for example, oftentimes 80% of their total cost, up to 80%, is actually the cost of goods sold or cost of sales, sometimes also called cost of revenues. As always in finance and accounting, we have various different names for exactly the same thing in there. So clearly for a retailer, this is what you need to focus on if you want to know how well your business is actually running. So if you want to actually make sure that the business thinks about buy low, sell high to the customer, buy low from the supplier, this is what retailing clearly is all about, then this is a crucial metric to find out how well you performed your job of actually squeezing suppliers, buying at a low price, and buying and selling at a high price to your customers in here. The next one we need to talk about here is already encompassing much more in terms of the income statement. We're talking as the next logical line item here, EBIT, earnings before interest and taxes. This encompasses now more of the expenses, more of the operating expenses, not only cost of goods sold, but also SG&A. What is that? Sales, general administrative expenses, R&D, and any other operating expense. So you've heard me already using the term operating expenses now several times. And this is exactly what EBIT is all about. EBIT is about looking at your operations, So you take your net sales and minus all the expenses which are related to operations. And whatever's left over is then called EBIT, or as we are now talking operations, profit from operations or operating profit. So what you do is you leave out at this subtotal here interest and taxes. Because in most companies, operating manager can actually not impact the interest and the taxes. If you are managing Daimler Argentina, you actually have no say how this legal entity in Argentina is financed. This is decided centrally by the Treasury Office in Stuttgart. So for that reason, we shouldn't measure you on something you can't impact. Rule number 1 of management by objectives. We shouldn't measure you on things you cannot influence in there. So for that reason, as this EBIT figure should be the figure the operating manager can actually impact, many companies actually use this figure for bonus payments. So I agree with you at the start of the year, this is the EBIT you should actually give us. And if you actually manage to actually provide this EBIT, you will actually get a bonus. Now, this is the reason as well, as we leave out the financing structure, the taxes, that strategy consultants like this figure a lot, because it allows us to compare different companies in the same industry and find out who's doing well in this given industry. Then we come to this little sister of EBIT, EBITDA, also called EBITDA. Now, EBITDA, what is EBITDA? You can see here, we take EBIT and then we add back the depreciation and amortization. I think depreciation is quite clear what that entails. Amortization, what is amortization? If you write down an asset you can touch, it's depreciation. If you write down an asset you cannot touch, so what is that? Patents, licenses, you call this amortization. Now, why do many companies actually switch from EBIT to EBITDA as a metric to compare themselves against competition or actually to pay bonuses? Because if you think about companies which have lots of assets, think about a cement producer, think about Holcim Lafarge or Cemex. One cement plant costs you $300 million to build. The issue of the cement plant is that when you take over this particular country where the cement plant is based, probably the cement plant was built 5, 10, 20 years ago and was decided by somebody who was no longer with the company in there. So what does that mean for you? You actually now come in, you have to manage this particular country where the cement plant is based, and you inherit those problems which were caused by somebody who maybe over-invested 5, 10, 20 years ago. Now come back to our rule of management by objectives. I only would like to measure you against things you can influence. The depreciation is something you cannot influence. And then the logical step is that you actually exclude the depreciation and amortization in order to get a finer picture of the line items in the income statement the operating manager can truly influence. The other thing obviously is that as MBA you know that depreciation is non-cash. And if we assume that cash generation is the ultimate motive and the ultimate driver of value creation, then it is quite clear that leaving out the depreciation brings us to a profit figure which is closer to cash compared to EBIT. So companies which actually have lots of fixed assets and have, for that reason, lots of depreciation, oftentimes actually decide to measure their managers based on EBITDA. The final point is, if you look, for example, in the airline industry, the question, if you compare two airline companies, let's say you compare Lufthansa against Air France, you cannot be sure that these two companies actually depreciate their planes over the same time frame. So is it 20 years or is it 12 years? Good question. As you do not know that if everybody's using the same rules, you actually have to move in and say, why don't we take out those numbers which are somehow arbitrary in the income statement? And depreciation has exactly this relatively arbitrary element. So EBIT, EBITDA, very commonly used to actually measure operating managers. EBT, earnings before taxes. You can see we're now moving down the income statement. Now, EBT, you can see obviously we now deduct interest expenses. We just said it, interest expenses in most companies is something which the operating manager cannot influence. This is oftentimes driven by tax consideration. So when you again manage your Daimler subsidiary in Argentina, the Treasury Department goes in and says, what is the tax rate in Argentina? If it's a high tax rate, then it might make sense to put a lot of debt on your balance sheet so that we have a lot of expenses and don't show a lot of profitability in Argentina in there. However, there is one industry where interest expenses are operating expenses. And this industry is, for example, banks or financial services in general, insurance companies. So for them, actually, it makes sense to take a number which is not EBIT to measure performance, because EBIT would leave out the interest, and paying interest and getting interest from the customers is a key component of financial services industry. So they oftentimes take this number actually to measure performance. So finally, net income, the final number of the income statement. First of all, and most importantly, this is not a number we should actually use to compare different companies in a given industry. Why is that? Imagine you have two competitors and you want to benchmark them financially. Now, what you would do usually is look at the income statement and look at the profitability. Let's imagine that these two companies are actually operationally identical. They have similar sales, similar expenses. However, one of the two companies is actually financed with 50% debt and 50% equity, whereas the other company is financed with 100% equity. Now, clearly, up till EBIT, these two companies would look alike if they are operationally identical. But if you go lower than EBIT, this is where things start to change. One of the two companies actually has interest expenses, whereas the other one, which is 100% equity financed, would not show any interest expenses. So that is then where the net income of these two companies would look different, even though they are operationally identical. And if you are a strategy consultant, you would like to actually look at the operating business and divide the financial side, i.e. the financing side, from the operating business. This is the reason why net income is not suitable for such kind of operating financial performance comparison in there. However, yes, there is a reason we still take net income as a financial performance metric. And this comes clearly from our owners. Our owners couldn't really care less who is responsible for which line in the income statement. What they care about is what is left over after all. After having paid suppliers, after having paid personnel, after having paid interest, and after having paid taxes. So what is left over for them? So that is the reason why all these investor-oriented websites like Investopedia or financial journals, which actually inform investors about their investment choices, they tend to take net income oftentimes. Many school books, textbooks take net income. Yeah, because at that point, the question is just how much has an investor invested in the company and how much is left over for this particular investor. So net income does have its role to play as well, and we need to discuss this in the next presentations as well.